think there are, we've been very careful about the risks, but there are actually some opportunities that perhaps financials are some of the unintended winners of some of the AI craze that we read about.
Hello, you're watching Proactive. I'm joined by Tom Dorner. He is fund manager for Polar Capital Global Financials Trust. Tom, very good to speak with you. Financials have outperformed over the past 3 years, but lagged the broader market this year. Is this just a pause, or are investors missing something?
Hi, Stephen. Thanks for taking the time. Yeah, so I'd say there's a couple of different ways to look at it. In terms of what's been driving the performance of the sector in the medium term, really, I think there is this legacy negative muscle memory that investors have had, but actually the performance, as you say, of financials has been very strong for the last few years, and that's been largely driven by pretty favorable earnings backdrop, because the interest rate environment has got more supportive, both in terms of base rate yields, and long-term yields have gone higher, been more normal, and in an environment that's no longer 0% interest rates, it's much easier for returns on equity for the businesses to be higher, and that's largely what's driven the strong longer-term performance that you were referring to. Recently, it's been a bit more volatile. Actually, absolute returns in the sector this year have been pretty good. So the sector's up about just shy of 10% year to date. But that's slightly behind global equities. And I'd say the large reason for that has been the uncertainty around geopolitics as a result of the conflict in the Middle East. So there was a bit of a sharp derating in financials a few months ago. But actually, we've approached a resolution, that's actually turned much more favorable and strong. The sector's had a very strong run in the last few months. So we're still sort of very confident about the outlook, and it's good to see some of the more favorable short-term momentum too.
Tom, you've been buying into market volatility rather than avoiding it. Why has that been the right strategy?
Yeah, so it depends a little bit what different bits of the sector. So in some areas we have actually pulled back tactically a little bit, particularly around the time that the conflict in the Middle East started. So we withdrew a little bit from some of our European banks holdings. It's a sector that we really like that tends to react more severely to this, and we bought some put options to buy some protection for the portfolio. But as a result of some of the volatility, there have been some opportunities too. So we took a new position in Admiral, which is a UK car insurer, is a very high quality business that has a long track record of gaining market share, and we got a bit oversold in some of the hysteria around autonomous vehicles. So that was an opportunity we took advantage of, and we also bought a position in Standard Chartered, which is a really great Asian banking franchise, which is on a multi-year return on equity improving trajectory, driven by growth in the wealth management business and some changes they're making in the commercial banking. So overall, at a portfolio level, really positioning hasn't changed that materially, but there have been a couple of things that we've been able to take advantage of, and the relative performance of the trust has been good. So we're pretty happy with that.
AI creating winners and losers across financials. Where do you see the biggest opportunities, and which parts of the sector worry you the most?
Yeah, it's an increasingly important question and increasingly significant driver of share prices. So if we focus on the areas where you might want to worry, the market, particularly a few months ago, has got very aggressive on this. I mean, the narrative was, well, we're going to have mass unemployment, and that's bad for banks, and insurance and financial products are no longer going to be intermediated by brokers, so that's bad for them, and anyone who sells anything that looks like data is in trouble. The reality has been a bit more nuanced than that. We did an exercise of looking at how the NAV of the trust is exposed to bits of our sector that we think are a genuine disruption risk, and the answer is it's pretty limited. But the market reactions have been pretty indiscriminate. So we've actually been trying to take advantage of some of that volatility. We've bought some insurance brokers, AJ Gallagher, recently, because it just sort of got ahead of itself. On the more positive forward-looking perspective, so actually there's a very interesting Accenture study of all the global industries, and you might be surprised to hear that banking and insurance sit right at the top of that in terms of ability to get operational efficiency gains through process automation. So the starting point is inefficiency is actually perhaps a good place to be when it comes to being able to be a winner from AI efficiency gains. And we've seen studies from PwC that really suggest the efficiency gains in some of the banks could be very, very material. And then you can reorient some of your employees towards doing higher value added tasks too. So I think there are, we've been very careful about the risks, but there are actually some opportunities that perhaps financials are some of the unintended winners of some of the AI craze that we read about.
You've stayed overweight European banks despite geopolitical shocks. Why are you still so bullish on Europe?
Yeah, so we've liked European banks for a couple of years now. Sort of 4 odd years ago, when we started to go overweight the sector, it was viewed as a basket case, partly as a result of this negative muscle memory towards financials generally that we talked about. But in the intervening years, the earnings growth has been really strong, and there've been meaningful earnings upgrades. At one point, they were outperforming the Mag 7 over several time periods. So sort of a hidden gem within our sector. The fundamental drivers have all been return related. So the returns have been much better. The businesses got themselves in order when interest rates were low and have now benefited positively from operational leverage. The balance sheets are in a much stronger position. The companies have all been making very substantial payments back to shareholders. So all of those fundamentally positive things have remained positive. What's changed more recently is that M&A activities really picked up, particularly in Europe, but it's a more global phenomenon. So it is a more we've liked the sector for a while. We're still none of the fundamental prospects that I was just mentioning have changed. It's a bit more consensual than it was before, but we still really like it.
You argue financials still look cheap despite strong returns. What do investors still not appreciate about the sector?
Yeah, I think it's a fair question. So the sector's done well, and the valuations are cheap. So that's helpful, but in its own right, not really sufficient to drive investor interest. The main thing from our point of view is that when we meet with companies and analyze their financial statements, the fundamental operating performance is still really, really good. Everybody's focused on technology, and rightly so, but fundamentals in financials still look very, very good. The macroeconomic backdrop is structurally much better because interest rates are higher, and that's why they're delivering returns on equity that are the best they've been for about a decade. In the long term, actually, if you look at where financials sit relative to global equities, currently financials represent about 17% of global equities, but actually in the mid-2000s, that number was more like 26. So if some of the sort of structural normalization in the composition of equity markets changes, that's a meaningful tailwind in addition to the strong fundamentals I was describing. The things that people really don't focus on is the deregulatory trend, particularly in US financials, which sounds kind of boring, but actually is a really significant change in the operating environment, because it goes from having been a constant headwind of like, you need more compliance, more cost, to actually now it's stable. And in some cases, there's evidence of reduced capital requirements in the US, but increasingly elsewhere too. So that's a feature that has yet to come, that was a headwind that I think is turning into a tailwind. So I think the combination of fundamentals, better macro, and some thematic things like deregulation still leave us to be very positive.
Tom, where do you see the biggest drivers of returns over the next year? AI, deregulation, M&A, or something else?
Yeah, it's a combination of those things, I'd say. So you want the companies, the banks, the insurers, the diversified financials to continue to deliver the strong operating performance we were talking about. I mean, we're just in the middle of Q1 earnings season, and the US bank results have been stellar. The European bank results have been good. So I think continued operational delivery is an important component of that. And then when you add on top of decent earnings growth, the fact that the strong balance sheets allow them to make attractive dividend and share buyback payments, the total return potential looks pretty good. So that's a solid fundamental underpin of shareholder return. And then you've got optionality from M&A activities. Some of our holdings have been acquired in the last year. Some of the deregulatory stuff that we talked about, I think that's a tailwind that's underappreciated. And then maybe, as we were saying, financials are sort of the underappreciated beneficiaries of efficiency gains from AI. I think the combination of those things is a pretty attractive package.
Tom, thank you very much for the introduction to the fund. It's been great speaking with you.
Thank you.
That's Polar Capital Global Financials Trust Fund Manager, Tom Dorner.